All right, chapter 2, the recording process, page 48. Learning objectives are on page 49. Number 1, describe how accounts, debits, and credits are used to record business transactions. 2, indicate how a journal is used in the recording process. 3, explain how a ledger and posting help in the recording process. And then 4 is prepare a trial balance. What'd you guys think of debits and credits? Confusing, right? So remember I kept saying it was easy? Fabulous. Have everybody met? It's Jacob, right? Yeah. Has everybody met Jacob? Jacob says it's easy. He's your new best friend.
Not this Jacob.
That's Jacob. Okay, so remember how I was talking about increasing and decreasing, not plussing, adding, minusing, subtracting. It's all about increases and decreases. If you keep in that frame of mind, increase and decrease, debits and credits will be easier. Okay, if you think in plus and minus, you're going to struggle with debits and credits. Okay, my favorite thing in the whole wide world, page 50, illustration 2-1. A T account. You will commonly hear me say, did you draw out a T account? Because as silly as it sounds, professionals still draw T accounts to work things out. Okay? If you're fixing somebody else's work, sometimes it's helpful to see how they recorded it and how it should have been recorded. And really, we're all visual people. It's why we like TV. It's why we like our devices. We like to see things. So it's a really great visual representation of what happened. Okay, so every T account has debits on the left and credits on the right. Okay? Questions on T account? All right, what is a debit?
A recorded transaction on the left side of the T account.
It's just the left side, okay? And it's going to be different for every account, right?
But in the book it was saying that it was also expenses and dividends when you do the chart.
Yes, we'll get there. We'll get there. We really just need to learn what's left, what's right, what's debit, what's credit. What each specific type of account, how they get classified, and how their normal balance changes is specific to expenses and dividends. But right now, we really just need to learn that debits are on the left, credits are on the right. Okay? Bottom of page 50, illustration 2-2. Remember how we were writing out all of those analysis? We were plussing, minusing on that. We was using our accounting equation. That's what they're showing in that tabular summary. Okay, but in accounting, we use the T account, and we do debits and credits. That's what they're showing you the account form. That's the difference. So in math, we use the tabular summary. In accounting, we use the T account and the account form. Yeah.
So debits would be increase and credits would be decrease when you're saying that right?
It depends. It depends on the account. Yes. Okay, page 51. What is the double entry system? What does that mean? Yeah, for every debit, there needs to be a credit, and the sum of all debits must equal the sum of all credits, right? So if I have a $100 debit, what am I going to have? $100 credit.
Now, on the account form in the 2.2, you don't quite have that mentioned.
There's no point. Say that again?
So in the account form, we're pushing 2.2.
Yeah.
You have more debits than credits.
Yeah, so these don't line up. So for example, the $15,000 is our starting balance. The $1,200 is one transaction. The The 1,500 is another transaction. The 600 is another transaction. The 7,000, another transaction. It's just different transactions. So in this example, they're showing them like across, but you don't have to do that. You can do them. You can do them like this. Okay. They're not equaling each other. It's just the way they've drawn them out.
On another table somewhere else, the corresponding credit debit.
Yes, this is just one account. Yep. All right. 51, debits and credits procedures for assets and liabilities. Okay, now this is where if I said you're a flashcard person or a memorization person, flip out those pages in the front of your book and just pound them in your brain, right? We have to learn the normal balance. What does that mean? What's the normal balance? What does that mean?
Normal balance is on the side where an increase in the account is recorded.
Yeah, it's where the normal balance sits in the account. So for example, cash. Cash is what type of account?
Asset.
It's an asset. What is its normal balance? A debit. How'd you know that? Besides reading the book. Reading the book?
Yeah.
Yeah.
Because cash is, the way I look at it, is cash is a positively polar event. It's positive, so it should always be, it's an income. It's not an outgoing, so it should be in the positive debits because you're getting money.
Yeah, what you think about your debit card is absolutely incorrect when it comes to accounting. Okay, your debit card, money coming out, right? It's money going in is a debit. Okay, maybe you think of it as you sticking your card in the machine, that's a debit. But when you take money out, that's a credit. Okay? Okay, so the normal balance of an asset is a credit. The normal balance of any asset, with a few exceptions that we'll learn later, is a debit. Did I say credit?
You say credit.
Sorry, credit. It's a debit, sorry. You got to tell me, because you were looking at me like... Okay, what is the normal balance of a liability? A credit. You increase a liability with a credit. Okay, so if I go to the bank and borrow money, that's a note payable, right? They're going to give me cash, and I'm going to owe them money. So I'm increasing cash, and I'm increasing my liability. What does my journal entry look like?
It's increasing on the credit and decreasing on the debit.
My journal entry is my transaction. What does my transaction look like? When we did all of our transaction analysis, what does it look like? If I'm getting money, increasing assets, increasing liabilities. The next step in saying what our journal entry would look like would be we debit assets or cash and we credit liabilities. Yes. So if I take out a note payable for $100, it's going to be debit cash, $100, credit note payable, $100. And then we always have a description to record note payable to the bank. Okay? That's how we convert all of that transaction analysis that we did to journal entries. That is a journal entry with debits and credits. Questions? We're on 51, bottom. That snazzy illustration 2-4, I hope that's in your notes. Or add it to a piece of paper, and when I give you back your notes, you can add it.
That's the only time we use a T-chart, right?
Oh no. Oh no, we use T accounts forever. It's funny because last Friday, my old boss, I do some consulting work for her. She is treasurer to a nonprofit, and I help train the bookkeeper, and I still help with the financial statements. So she was asking me how it's going, and I explained how I always tell people, you know, we still use T accounts in the real world. This isn't something just for school. And I explain, you know, like, tell you guys, draw out a T account. She kind of laughed, and she's like, it's so true. And she's a partner of the firm. So I'm telling you, like, it's for real. When you draw T accounts, you still use them. You take them to partners. You work it out. They may look differently, but you still use the process of a T account in the real world. All right, let's move on. Page 52. Okay, normal balance of an asset was a debit. Normal balance of a liability? Credit. What about stockholders' equity? Credit. How'd you know that? It's opposite. You don't know? Okay, that's all right. How'd you guys know the normal balance of an equity? It's on the right side. Remember, what was our accounting equation?
Assets equals liabilities. Plus debt, SEP.
Yeah. Assets equal liabilities plus equity. Right? Our debits have to equal our credits. Liabilities and equity are on the same side. Right? So equity is going to be a normal balance of a credit. Okay, so for all those transactions that we did where we purchased stock, so I think it was the Neals, right, and SoftBite purchased stock. They purchased stock. They handed me $15,000. I gave them stock, which is a what? What kind? Is it an increase or a decrease? Increase in common stock, which is what? Equity, right? If we sell common stock, that's an increase in equity. So what does our journal entry look like? We debit cash, right? Because they gave us cash, and we credit common stock or equity. Okay? We always start with the debits. The credits always come next. So if we have 10 debits, we have 10 debits first and then credit. Okay, so illustration 2-6 on page 52. Our normal balance for common stock is a credit. So we increase common stock with a credit. How do we decrease it? A debit. So it's the opposite of however you increase it. Okay, so what do we know about retained earnings?
It's the revenues minus,
It's a part of equity. So if equity and stock increase with a credit, what do we think is going to happen with retained earnings? Same thing, right? It's going to increase with a credit. So that's illustration 2-7. All right, here's that fun one. Dividends. What is a dividend? You're paying your stockholders. What are you going to say?
Yeah,
You're going to pay your stockholders, right? So are you increasing or decreasing equity? You're decreasing it. So what is the normal balance for dividends? It's a debit, right? It's having the opposite effect as somebody purchasing stock, right? Somebody purchases stock, money's coming in. When we pay dividends, money's going out. We are reducing our equity. So on the top of 53, illustration 2-8, the normal balance for dividend is a debit. Okay? So when we pay out dividends, we are increasing that account with a debit. How are we doing so far? Better than over the weekend?
Do we have a quiz today? We have a quiz?
You had a quiz due online, yes.
Oh, I mean today?
I never give pop quizzes. Is that what you mean?
No, like, there's a quiz too today, right?
It opens Wednesday after class.
Oh, okay.
Yeah, there's nothing between Monday and Wednesday.
Oh.
That would be murderous. Right? Nothing between Monday and Wednesday. But and never pop quizzes. That's just mean. Well, that's my opinion. All right, revenues and expenses. We have to remember their effect on equity. Okay, so revenue is what? What's happening when we receive revenue? It's an increase in equity. Only think about the equity part, because we may receive it in cash, we may receive it in accounts receivable. The asset component we don't think about, right? When we receive revenue, we are increasing equity. Okay, well, how do we increase equity?
By increasing credit.
With a credit. So the normal balance of revenue is a credit. Okay, expenses. What effect do they have on equity? They decrease equity. How do we decrease equity? With a debit. So the normal balance of an expense is a debit.
Oh, yeah.
So there you go. Assets and expenses and dividends all have the normal balance of a debit, right? For different reasons, though. Do we see that? Liabilities, equity, stock, retained earnings, they increase with a credit.
And then when you debit expenses and dividends, it's a credit cash usually, right?
If you pay with cash. If you don't pay with cash, what do you do?
Accounts receivable? Oh, no, payable.
Or some type of payable, accounts payable, notes payable, right? Because you're going to pay them in the future, you create a liability. You either drain your bank account, right? Or you pay them with a note or a loan. All right, so that's illustration 2-10, the normal balance for revenue and expense. It's opposite of each other. Bless you. Okay, page 54, illustration 2-11. What does this look like?
It's like a balance sheet.
This is a really condensed version of all of our financial statements, right? Okay, and it's out of order, right? So they're showing us at first, we have investments by stockholders. I think that's why they put the balance sheet first. So that's why they're showing us the common stock. Then we have our income statement with revenues less expenses. Gives us either a net income or a net loss. Then we add that to our retained earnings. We subtract any dividends. And we're left with our ending retained earnings, which goes back on our balance sheet as part of our equity. All right, illustration 2-12. If this isn't on your pink sheet, I would add it to your notes right now. It's the expanded accounting equation with the debits and the credits. The plus means increase. I prefer arrows up, not a plus. And the minus means a decrease. I think it's more helpful for me to know increase, decrease. Just because that's what they've done throughout the rest of the chapter with the green and red arrows. Yeah.
I had a question about
Uh-huh.
that. This is for the expanded equations. Is common stock plus retained earnings plus revenues.
Yep.
Minus, doesn't retained earnings equal revenues minus?
It does, but in the expanded accounting equation, we list them both.
Oh,
Yeah.
so you add them both.
Well, we list them both so that you know they're the same.
Oh.
Are they using sense of cancel each other out?
No. If that section is confusing for you, I would kind of circle retained earnings, circle revenues, expenses, and dividends, and maybe put like a little equal sign in between so that you know it's the same. Just remember when we drew out our expanded equation, it was retained earnings, and then we broke it down to the next level. It's just it's too hard to do that with debits and credits, so they did them all in one line. But I see how that could be confusing. All right, page 55. Do it number 1 in your groups. Cover the solution. Talk it out.